Conventional loans are the most popular loan option for people looking to purchase a home. One of the most attractive benefits of a conventional loan is their high max loan amounts, because the baseline loan amounts for conventional loans are much higher than the FHA loan amounts, which is a little above $472,000. But so many people have had difficulties in the past obtaining this type of financing when they look at all of their loan options. And one of the main reasons is the down payment requirement. So in this video, we'll go over what a conventional loan is, what are the new loan requirements and max amounts, and how you can get a down payment of as little as 3%.
Wow, that sounds like a really good deal.
Hi, my name is Trenton Ward, and if you enjoy this content, let me know by hitting the like button and consider subscribing to stay up to date with the latest real estate news, tips, and tricks. So the first topic we're going to go over is, what is a conventional loan? Conventional loans are loans that aren't backed by the government in case the borrower defaults on their loan. And because they don't have to follow the same guidelines as their government-backed counterparts, there is a lot more variety of these types of loans. Conventional loans that don't follow the government guidelines set by Fannie Mae and Freddie Mac are referred to as non-conforming loans. And since they don't follow these guidelines, there aren't any set requirements. Now, when you apply for a mortgage with a lender, they'll more than likely present you with the conforming loan options so they can easily sell your loan after you close. So for that reason, we'll stick to the guidelines you'll more than likely encounter, which will be the conforming conventional loan guidelines. The most common government-backed loans that you compare a conventional loan to would be a FHA loan, VA loan, or a USDA loan. One of the biggest advantages of these types of loans is that there is little to no down payment requirement. And that's due to the fact that the government insures these loans, so the lender exposes themselves to a low amount of risk. But on the other hand, conventional loans typically require a larger down payment amount. In the past, home buyers would be required to pay anywhere between 5 and 20% down to obtain a conventional loan. But luckily, now we have some programs that can give you a down payment of as little as 3% that we'll get into in a bit. Okay, so now that you have an understanding of what a conventional loan is, let's jump into some of the requirements. The first requirement we'll go over is private mortgage insurance, or PMI for short. If you put a down payment of less than 20%, you'll be required to pay for PMI. This is insurance that protects your lender in case you default on your loan. An example of this situation would be if you had to go through a foreclosure due to some unforeseen circumstances. The amount you pay for PMI varies based on your financial situation. Those that have higher credit scores, lower DTIs, and put more money down will pay less than those that don't have the same criteria. And just to give you an idea of how much of a difference it would make, on the lower end, you'd pay around 0.5% of your loan amount, and on the higher end, you'll be closer to 1.5%. PMI will be paid for as part of your mortgage payments. The good news is that you don't have to continue to pay it forever.
Now that's some good news. That's good news. Great.
Once you receive more than 20% equity in your home, you can request for this payment to be removed. In order to do this, you'll need to contact your mortgage service provider, and they'll do an evaluation of your current equity in your home. They're supposed to do this on their own, but I wouldn't wait around for it. Staying up to date with the value of your home can end up saving you years of PMI payments if you're able to notify them in a timely manner. Okay, so now that we've gone over the cost of getting a conventional loan, let's move on to how much you can buy with one with the maximum loan amount. For conforming loans, the maximum loan amount that you can get will be based on the location of the home that you'll be purchasing. Areas with a higher cost of living will typically see a higher max loan amount. The maximum baseline loan amount as of 2023 is $726,200 for a single family home. And as you go up in the number of units in the home, you'll be able to see the maximum loan amount increase as well. The maximum loan amount in a high cost of living area is $1,089,300. There are a total of 16 states plus the District of Columbia that have counties that are eligible for the maximum loan amounts. Some of these states include California, New York, Colorado, and Florida. But if you are in one of these states, you could still have a higher limit than the baseline amount. It's just that your area will fall somewhere between the two amounts. Okay, so now let's discuss the 3% down payment options for conventional loans. The first one we'll discuss is the Conventional 97 Loan Program. This program is from the lending guidelines of Fannie Mae. The 97 stands for your LTV, which is your loan to value amount, because you'll be left with 97% once you put down your 3%. This program is only for first-time home buyers, and in the context of this program, that means you haven't owned a home in the last 3 years. Your new home will be required to be your primary residence, and it can only be a single unit home. This is how many programs get away from having too many investors participate in these programs, because this prevents the purchase of a large investment property like duplexes, triplexes, and so on that investors tend to gravitate to. If everyone on a loan application is a first-time home buyer, at least one of the applicants will be required to go through some sort of home ownership education. And this is for all conventional loans with a LTV above 95% for Fannie Mae. Now, if you're not a first-time home buyer, you still may be eligible to get a 3% down payment option. The other options will be a Fannie Mae HomeReady mortgage or a Freddie Mac Home Possible mortgage. Both of these options are very similar because they're income-based mortgage options. The income restrictions are going to be based on whatever location you're buying the property in. So if you're in a low cost of living area, you can expect to have a lower maximum income requirement and vice versa. But there are two major differences between the two programs. The first one is the HomeReady mortgage loan program will allow you to use renter income on your application. So say for instance, you have someone else that's renting a room for you in your home. You can add that income on your HomeReady application because that's income that, in theory, you continue to collect because your renter will move in with you. The other big difference is that for the Freddie Mac Home Possible mortgage, you'll need to have a credit score of at least 660. The Fannie Mae products have a lower credit score requirement though. They'll follow the normal conforming conventional loan requirements that we're about to discuss. Although you may still have some lenders that'll increase their requirements based on their own risk tolerance. Okay, so now let's discuss the qualifications to get you a conventional loan. In order to get a conventional loan that conforms to Fannie Mae's requirements, you will need a minimum credit score of 620. Your individual lender may require something a little bit higher, like say 660 or more, but 620 is where you'll start to see some lending options. Your DTI, which stands for your debt to income ratio, will need to be 50% or lower for most conventional loans. Your DTI is just an amount of money that you make versus how much you owe on a monthly basis. In order to qualify for this high of a DTI, most lenders will require you to show other indicators that you'd be a low risk. For instance, having a high credit score or having a large amount of cash reserves are some factors that can work in your favor. You will also need to show proof of stable income. Most lenders will be looking at your last 2 years of employment. If they're embracing your employment within this time frame, you may still be eligible, but they'll need an explanation to ensure it's a qualified exception. And lastly, you'll want to have a clean credit history in terms of no recent bankruptcies or foreclosures. Okay, if you've enjoyed the content, let me know by hitting the like button and consider subscribing to stay up to date with the latest real estate news, tips, and tricks. If you have any real estate needs, feel free to reach out to me. My contact information will be in the description below. And until next time, peace.